Here is a number that puts everything into perspective. The euro is the shared currency of 20 separate national economies, serving more than 340 million people across the European Union. That makes the Eurozone the second largest monetary bloc on the planet, and it means that a single decision in Frankfurt can ripple from a factory in Germany to a tourist resort in Greece within hours. So on this report for the 17th of June 2026, the question we are really asking is simple but powerful. Is the European financial machine running smoothly, or is it under strain? Over the next few minutes we will break down the euro, the European Central Bank, inflation, bond markets and equities, so you understand not just what is happening, but why it matters for your money. Before we dive into today's figures, let us set the stage. The European Union is one of the largest economic areas in the world, with a combined gross domestic product measured in the tens of trillions of euros. It is a trading superpower, deeply connected to the United States, China, and the United Kingdom through goods, services, and financial flows. The single market allows capital, labor, and products to move freely between member states, which is exactly why an analyst cannot look at France or Italy in isolation. When German manufacturing slows, demand falls across the supply chain in Central Europe. When Spanish tourism booms, services data lifts the whole bloc. This interconnection is the heartbeat of every credible EU financial report. Let us talk about the currency itself, because the euro is the most visible health check of the bloc. The euro to United States dollar pair, known as Euro-USD, is the most heavily traded currency pair in the world, accounting for a huge share of daily foreign exchange turnover that runs into trillions of dollars globally. When the euro strengthens against the dollar, European exports become more expensive abroad, which can squeeze manufacturers. When it weakens, exporters cheer but imported energy and raw materials cost more, feeding into inflation. The same logic applies to the euro against the British pound, a pairing watched closely by anyone trading or traveling between the EU and the UK. A patient analyst does not chase every tick, instead they watch the trend, the trading range, and how the market reacts to fresh economic data. At the center of it all sits the European Central Bank, headquartered in Frankfurt. Its primary, legally defined mandate is price stability, which it targets at 2% inflation over the medium term. The ECB's most powerful lever is interest rates, and in particular the deposit facility rate, which sets the floor for borrowing costs across the entire bloc. When the bank raises rates, it cools spending and borrowing to fight inflation. When it cuts, it tries to stimulate growth and lending. The Governing Council meets roughly every 6 weeks, and markets hang on every word from the President's press conference, parsing the language for hints about the next move. For this report, the key takeaway is that the direction of ECB policy is the single biggest driver of European bonds, the euro, and bank shares. Inflation is the data point that shapes everything else. Across the Eurozone, inflation is tracked through the Harmonized Index of Consumer Prices, a standardized measure that lets you compare price changes fairly between member states. A few years ago, Eurozone inflation surged into double digits in some countries, driven largely by an energy shock and supply chain disruption. Since then, the broad trend has been disinflation, meaning prices are still rising but at a slower pace, gradually moving back towards that 2% goal. Analysts pay special attention to core inflation, which strips out volatile food and energy prices to reveal the underlying trend, and to services inflation, which tends to be stickier and harder to bring down. If inflation is cooling steadily, the ECB has room to ease. If it proves stubborn, rates stay higher for longer. Now for the part many viewers overlook but professionals obsess over: government bonds. The German 10-year bond is the benchmark safe asset of the Eurozone, and its yield is treated as the risk-free reference for the whole region. The crucial concept here is the spread, the gap between what riskier countries like Italy pay to borrow and what Germany pays. A widening spread is a warning sign that investors are nervous about a particular nation's debt or politics. A narrowing spread signals confidence and calm. Because bond yields move opposite to bond prices, falling yields usually mean investors are buying safety, while rising yields can reflect either stronger growth expectations or fresh inflation worries. Watching the Bund and the Italian BTP together tells you more about market mood than almost any headline. Equities give us the optimistic, forward-looking view. The headline gauge for blue-chip European companies is the Euro Stoxx 50, which tracks 50 of the largest firms across the Eurozone, spanning luxury goods, banking, energy, technology, and industrials. Alongside it, national benchmarks like Germany's DAX and France's CAC 40 paint the local picture. Bank shares are especially sensitive to ECB policy, because higher rates can widen the margin between what banks pay savers and charge borrowers. Meanwhile, exporters and car makers react sharply to the euro's strength and to global demand from China and the United States. When you assemble these pieces, a strong equity session usually reflects confidence in earnings and a stable rate outlook, while a sharp sell-off often points to growth fears or a policy surprise. So what is the bottom line for the 17th of June 2026? The European financial story is fundamentally about a delicate balance, the ECB steering inflation back to target without choking off growth, the euro reflecting that confidence in real time, and bond spreads acting as the early warning system. If you remember just 3 things, make them these. First, watch the ECB, because rate direction moves everything. Second, watch core inflation, because that decides the ECB's next step. Third, watch the spread between German and Italian bonds, because it reveals hidden stress before it reaches the headlines. Markets reward patience and punish panic, so focus on the trend, not the noise. Thank you for watching this EU financial analysis, and keep these signals in mind as the next set of European data lands.